So I'm seeing a lot of traders struggle inside of the only 2 days we've had to the start of this week. And what you recognize a lot, I've been trading for 6 years, and through that, when a trader isn't able to sit through 2 days of maybe they're not completely sure where price is going or what it's going to do, oftentimes they really go back to their old ways of resorting to taking pattern trades. And your model is not a pattern. Your model is a way for you to align yourself with the current order flow in order to reach the expected terminus of the move. When we start seeing traders take very, very low probability trades, some of them may take an inverse up here, right? I saw someone draw their fair value gap out like that, and that's not even how you draw it correctly because the volume of balance has to be included. So a lot of people are struggling, and I really want to go over how to avoid blowing your account in this because everyone and their mother sees this new week opening gap, which the new week opening gap is not drawn from here to here. That's not even the complete liquidity void. The liquidity void rests there. Regardless, a lot of traders are not able to sit still through 2 days waiting for the correct time for when price should make a reasonable move. Now, reasonable move, this is a very good move, but it's very, very difficult to trade it. And I'm sitting on my hands until post FOMC, and I think everyone should have been doing the same, regardless if they were able to catch a high probability trade. In their eyes, I still think it's gambling. But if you're trading throughout this or throughout this time distortion, I I really am a strong believer that when someone says stick to your model, trust the process, on all of that bullshit, most traders don't even have a basic understanding of price action, and their models suck, and that's their fault, but it's also on their model. So how you overcome that and that impulsiveness is having a model that works. I don't care if price rallies up 1,000 points here before FOMC because I know next week I'm going to come into the marketplace and I'm making money. That is a level of confidence, not arrogance. It's a level of confidence that can only come through hard work of backtesting your model, understand where it works, why it works, when it doesn't work, and why it doesn't work. And once you backtest that trading model rigorously over and over and over again, just like what I posted on my Twitter the other day, two backtested examples of my Cairo model, then you have to journal that as if you saw it in real time. You're giving yourself that pseudo experience, and once you journal it as a positive case study, the next time you go sit in front of the chart, you're not going to be filled with what if paralyzing thinking. And that's really the only way for anyone to be able to overcome that. So, having the understanding of time and your model, when it's supposed to form, when it's not supposed to form, forcing something. This is an hourly fair value gap here. Takes out the short-term low, trades into the hourly fair value gap. Here you have your Cairo. Inversion here at the time when you're expecting it to occur. But what's the issue? A model doesn't just consist of an entry, a stop loss, and a price target. It has to have order flow. It has to have market structure. It has to have narrative. The narrative and the actual order flow that's presenting itself. What's being respected, what's being disrespected? Is the order flow confirming your model? All of those things combined make up the entire trading model. So when we're using the economic roadmap as a roadmap for the entire week or even the month in some cases, when everyone, including retail, is seeing this new week opening gap. What do you think is going to happen? Well, what did happen? Right? This is backtesting, not Forex replay. What did happen was after this, we had a new week opening gap right here on May 12th. And what happened? Did it ever get traded back into? Do you think retail traders weren't expecting this to get traded to? Do you think retail traders aren't expecting this to get traded to? So when you have case studies and experiences like that of understanding why and when new week opening gaps get left open, it's unreasonable to say if Monday wasn't going to do it, then Tuesday's not going to do it here. And it's going to maintain that, and it's going to wait for a specific event. Because even if the new week opening gap gets completely filled in, which I don't know right now if it is, I need more data. And there's nothing wrong with being able to say that. But expecting a 2% drop when you have major economic news coming out in the forward coming days, on Wednesday, on Thursday, you have Trump in China. It's super unrealistic to expect those things to occur. And every once in a while, they're going to occur. Great, fine. You know, an extra normative scenario does not make it the normative case. So when those normative cases are built up in your trading journals and you have them over and over and over again, and you know exactly what's going to happen and why it's going to happen, you know when to push. But if it's not clear to you and you're making a case for either side of the market, if this happens, then this is going to happen. That's not an understanding of price. That's not an understanding of what the market's about to do. Why the would you ever want to trade anything like that? Why do you want to trade something that's a 50-50 condition? Well, you don't have an understanding of the price action, which is only found by backtesting. Going into your old charts, figuring out what occurred, why it occurred, and what move occurred. Just like this. It's already marked out. Everything inside of price action, based off of the algorithmic delivery we subscribe to, journaling it, understanding it, what occurred, how did it occur, what happened, what do you think could have happened, and what could you have looked for? And that's the part where you have to be honest. Okay, well, these were relative equal highs. Why didn't it get ran on Thursday? Why did it come back down to this daily BPR inside of here, to consequential encroachment? Why did all of these things like that take place? Those are questions that have to be answered. So when you go to the current price action, you're able to say, okay, things like this have occurred before, and I understand it. So I'm not going to unnecessarily push price into this little mold and force my will upon it. That's stupidity. Why would anyone ever want to do something like that? So traders who are not following a rule-based system and a rule-based ideology are going to sit there in front of the charts. They're going to say, okay, let's just take a trade because this is a bearish fair value gap. Oh, but look, it just got inversed. Here's an inversion fair value gap. Right? Let's go long. Absolutely not. Because what's it doing? What's all of this price action doing? Short-term high taken out, builds relative equal highs, engineers liquidity into first presented fair value gap. Look at the bodies throughout here. What inside of this is screaming at you that price is bullish? Quadrant. Look at the bodies. Look at the quadrants. That is perfect delivery. What is telling you that something is bullish inside of here? Body closes on consequential encroachment after wicking the high out, builds relative equal highs. Then what does price do? It comes back down lower, almost to the hourly fair value gap. Doesn't quite get there, but what does it do instead? It trades up, short-term high, then drops to the hourly fair value gap. This, all inside of here, sets up the time after price runs into the hourly fair value gap, then starts the lunch session. Everyone inside of the morning session has already been stopped out. Low taken out here, low taken out here, low taken out here, low taken out here, low taken out here. This low wasn't taken out, I meant that takes that low. But regardless, what's it leaving? Relative equal high, relative equal high, relative equal high, relative equal high, relative equal high. What, when you're asking yourself, who has been hurt inside of this marketplace and why? Who's next to be hurt? If you were controlling price, what would you specifically do with price to let everyone else be hurt while you still get to profit the most? Because that's how algorithmic delivery works. Smart money pairs orders of buy and sell stops and runs it the other way. So when we have these things and we're able to filter out based off of our rule-based systems, that isn't just a 1, 2, 3 quick, 5-minute trainer video. It's something that's nurtured, it's loved, it's built upon. And when you continuously build upon that model with positive experiences, with not jumping into the market too quick before you're even ready to, if you're trying to trade inside of here and you're taking loss after loss after loss, all you're doing is you're developing mental scar tissue. And that's incredibly difficult to overcome. Especially now, you're going to be demoralized and you're not going to want to have to spend months to try and overcome that. It's not an easy thing to do. It's a very rewarding thing to do because now you have a skill no one is ever going to be able to take from you. But if you're not following a rule-based idea with specific plans, what is the daily profile? Am I expecting a New York reversal? Am I expecting a low resistant liquidity run to the downside? Is that what the daily profile is calling for? What's the weekly candlestick reaching to? Why is it reaching to there? Why did we have the drop during Trump talking about China? Right into the weekly fair value gap. Overlapped with that wick. Oh, look at that. Okay, so now all of a sudden, those things aren't scary, and that's a pyramid position for longs. So when you have everything combining and combining and combining, everything just makes it so relaxing and blissful to be able to sit inside of the marketplace and not hyperfixate on getting a trade. Because when I'm going into a trading day, I'm not worried about saying, okay, let's go into this day and let's get a nice win. The second you do that, all you're doing is you're emphasizing the importance to have a win. So whatever trade you're going to get into, the result of that trade is elevated to such an Olympic level of importance that is not going to be able to have you sit there and make a completely detached decision from either the money or the outcome, having to show your trade-off to other people because everyone else is doing well and you're not. Whatever the reason is, that system that you're following, the reward of following that system is getting to become profitable over time. It's not a quick thing either, right? You're not going to just go from unprofitable and now you have a model and now you're going to reach for 150 points. You have to reach for low-hanging fruit and build yourself up and build that confidence up. That's how you overcome mental scar tissue. But when you have traders out there trying to sell you some garbage when they don't even know how to draw a fair value gap properly, and you want and are trying to push and push and push, but you're not doing any of the work. You're doing busy work, but busy work isn't always good work. You're just wasting your time. When that model becomes your focus, now you're focused on price action. Is price doing what you expected to do based off of that trading model? Yeah? Then why are you worried about anything? Price is doing exactly what it should be doing. But when you don't have a model and you're just saying, okay, here's the fair value gap, there's a sweep, now I can long. That's not a model. It's incomplete. You're now going to feel like every single tick against you is going to be the start of the run on your stop loss. So you're probably over leveraged to care if you get stopped out, and you're also not following a model. And it all goes back. Why does trading always go back to you? Why does it matter if you're doing the work or not? which seems like a stupid question, but most traders never ask it. What is the work? The work matters because you're conditioning yourself. You're practicing like a surgeon practices on a cadaver to make very precise movements. That's the whole point of backtesting. Replay mode is not backtesting because price is moving forward. That's a forward test. It's a glorified forward test too because price doesn't actually move like that. So it's stupid. If it works for you, it works with you, fine. But when I continuously see traders make the same mistakes, ask the same questions, it's mind-boggling how you can have anyone. You don't need to listen to me or any other guru. Just listen to ICT. And that basis of understanding, put your work into that and let that grow. Journal. And you can't treat it like it's a little hobby. Because if you're treating it like a hobby, trading is a zero-sum game, even if you're in prop firms. When I get a payout, you're paying me. Your blown account is paying me. When you're trading with real money, your stop loss is going to someone else. You're competing. It's war. It's not a fun little video game. If you think you're going to go out there and compete against the most corrupt and smartest people to have ever walked the earth, you're doomed to fail. Like, you can't be that ignorant. You need to put the work in. You need to understand basic math to kill your greed. What compounding do I need to do? How many wins do I need? Very small low-hanging fruit objectives. And those low-hanging fruit objectives, those goals, the reason we have them is because if we're not reaching for anything or if we're not aiming for anything, we're not going to hit anything. Right? You go into the marketplace saying you want to be rich, but how does that look? What does that look like? If you have nothing to aim for in order to get you there, you're not getting there. And that's really the key. Making one smart, thoughtful, educated decision, that's what Bill Ackman said, every single day. And those things add up. And over the course of not even a month, but over 90 days, you're going to see, today, I didn't really care about taking a trade. I was fine missing that move. Or I took a loss, and it doesn't matter because yesterday I had a win, and that was really good, and I saw price clean. So today, I'm not looking at that loss as a negative. I'm looking at that loss as something that I can learn from to improve and make sure that I'm better in the future. And now it's a giant paradigm shift because you're not afraid of taking a loss. You're happy when you take a loss. You're accepting of that loss and you're going to nurture it. You're going to sit in it, see how it feels, what occurred, what did you expect to happen, what actually happened, what did you do, and what should you have done. Everything that goes back to my journaling video. Develop your trading model, don't be lazy, and go take it for yourself. It's that simple.